Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18, and let's get a conversation going on the market now. Ashi, Anand, CIO of Valcreate Investment Managers, joins us now to discuss where things could really be headed from here. Ashi, thanks a lot for joining us. This is Pavitra. Now, just for a quick introduction, the two main funds that Ashi looks at, there's a digital disruption theme that he is looking at, which essentially means all of the new age companies, and there's also a concentrated micro trends fund. So very interesting pockets to be discussing. And Ashi, I want to come to you on this entire new age set of companies first. Take us through, what you've identified within this space and why you are so optimistic on these.
Pavitra, so if you just look at the broad thesis behind digital disruption, what we have seen, if you just look at, say, the US over the last decade, you saw a tremendous amount of outperformance of the NASDAQ to the overall indices. Now, we're seeing something very similar play out in India over the coming decade. And if you just look at the broad thesis, the first one is we expect digital platforms to continue to grow substantially faster than traditional kind of businesses. You are seeing a tremendous level of value migration taking place towards digital platforms. Now, this is across the board. This could be kind of food apps like a Zomato Paytm, a Zomato Swiggy. It's kind of your payment apps. It is shopping. Across the board, consumers are shifting towards digital platforms. Now, penetration rates in India are still relatively very low. At 86 crore internet users, we are the second largest internet market in the world. But if you look at specific penetration rates, we have 5 crore people ordering food online. This compares to kind of over 50 crores in China. The 18 crore online shoppers in India, over 70 crore in China. India, according to us, is still very early in terms of its digital adoption. As you're progressing over the next 3, 5, 7 years, you start to see a lot of people who've been brought up digitally native, starting to actually enter the main consumption workforce. And as that happens, we expect growth rates to continue to remain very strong. So growth is one element. Now, the second core element of this puzzle is in terms of profitability. A lot of people are comfortable in terms of the high growth rates that these platforms have, but are concerned about why these companies aren't really making profits, or some of them were making very heavy losses a year and a half back. Now, we launched this fund in February, and we took a very deep dive in terms of the cost structures of these companies. And if you actually examine and understand these cost structures, over 50 to 60% of overall cost is actually directly attributable to these companies being in a hyper growth phase. These costs can actually altogether go away over the longer term as kind of growth overall normalizes. Now, this can lead to very substantial kind of margin expansion. We've done long-term models. We're seeing very healthy profitability emerge across the space. Now, a combination of high growth and a shift towards profitability leads to kind of a very attractive kind of overall scenario for value creation to take place. And this is what kind of makes us so optimistic about this theme.
Growth was never really a challenge for any of these platform companies. The only risk was that cash burn. And now there is a firm commitment from the promoters to bring it down. And you are seeing all these companies get on that path of profitability. The only question here right now, still in the minds of many, is this the right time? Because valuations have, they're not at peak levels, but they're still perhaps not at attractive levels. How would you respond to that point about valuations? They're still baking in a fair amount of, profitability in the future. And just one more point, particularly in the stocks that you hold, I see you've got a Nykaa. Just for the benefit of our viewers, you've got Zomato, Policybazaar, Paytm, Nykaa, and InfoEdge. These constitute the 5 stocks in your digital disruption portfolio. On Nykaa, there are some concerns about competition. How would you respond to that?
So if I can just first address valuations, I would like to disagree on valuations. If you really look at valuations from a longer term perspective, right? If you look at where earnings can be 5 years and 10 years down the line, and we've actually sat and we've built our models, we've got our projections around how both revenues and margins shape up. And if you then look at valuations from that construct, right? Because you cannot value these companies today. They aren't making profits. You can't use any of the traditional valuation-based multiples. Our call is that markets are still underestimating the longer-term growth and the longer-term profitability of these businesses. These businesses are also going to generate a tremendous amount of cash as they start turning profitable, because there's really no large capex or working capital requirements across most of these business lines. So while we are aware, we launched the fund in February. Timing at that time was a great timing. We pretty much got the bottom. You have seen kind of stocks move up 50 to 100% from there, but you are still actually well off the peaks. We are comfortable on valuations. We believe that as long as you hold these companies over the longer term, these are not short-term trading plays. It's not advisable to go in and out of these companies. But if you hold them over the longer term, we are very clear value is migrating towards the space. And you shall see that in terms of market capitalization and stock prices. Coming to Nykaa, yes, it is true. You are starting to kind of see competition become a little more aggressive. This is something that we are constantly kind of evaluating in terms of our portfolio holdings. The competitive barriers to entry and what's happening in terms of competition is something which is extremely important, right? Because these are, like I said, long-term buy and holds. You have to ensure that nothing happens to come in and disrupt them. Now, while competition is kind of coming in, I think competition is still in relatively early stages. And if you understand Nykaa's core proposition around the kind of brand awareness it has built in terms with the consumer, the very large influencer network that it has built, and this overall large community, that is something which, according to us, is actually very difficult to replicate. So while competition is coming in, whether competition is going to be successful in terms of displacing a Nykaa, we aren't really sure about that yet, but it is obviously something that we are watching closely.
All right, very interesting thoughts there, Ashi. The other pockets that we want to talk to you about is this entire theme of concentrated micro trends. I know you have banking, consumer, capital goods, real estate, a lot of those, but let's begin with real estate because, a lot of these stocks have been doing very well. We just got the Q2 updates also for them, and demand, especially on the premium end of things, is looking very solid. So tell us, how would you play this back? Is it through, just the main real estate companies? Are there sort of ancillary companies that also look attractive to you on the back of this?
So let me just quickly explain what we mean by a micro trend, right? So real estate is a sector. What a micro trend is basically sub trends that you're seeing within a sector. So while we are very bullish about real estate, we are bullish about residential real estate. Commercial real estate, honestly, we are a bit concerned about in terms of what's happening in terms of supply coming in, work from home risk, etc. So we concentrating on companies where you are getting attractive residential exposure. Our view on real estate is that 2010 to 2020 was really a lost decade in terms of the real estate sector. Prices had moved up too substantially over 2002 to 2008. And this made a very high base, made it very difficult for people to afford homes. As you've kind of had a decade where prices were broadly stagnant, incomes moved up, and also interest rates bar the current kind of rise also kind of reduced, affordability has improved substantially. You take on affordability, you take on this very large discretionary consumption play that is happening in India, the desire for people to actually own homes having increased post-COVID. We're seeing other larger kind of macro trends at play, right? Urbanization, nuclearization of families, rising aspirations. All of these lay a very conducive environment for kind of residential real estate demand to pick up over the coming decade. And we're already seeing signs of this, right? You're seeing this across the board in terms of the numbers coming out across residential real estate companies over the last year and a half. Our view is that one, this is going to sustain over the kind of medium to longer term. Secondly, as kind of inventory starts to kind of go down, you will also start to see price hikes and you will also start to see that benefit. Now, all of this will basically play through in terms of the NAV improving, and accordingly, we continue to be quite bullish on real estate over the longer term.
Okay, thank you very much for that. Just yesterday, we had HDFC Securities institutional equities head, and he was telling us that how they're overweight on real estate in their model portfolio, and they've picked Shobha Developers as the stock that they like. Get into a break. Thank you very much, Ashi, for joining in. On the other side, we'll get you a quick analysis of the IT Q2 FY24 earnings so far, and what's the stat that stood out.